Hello and welcome to the 7th episode of Meet is Capital. We will try to give you our perspective on emerging and frontier markets on a quarterly basis. Today is Thursday, the 10th of April. My name is Grapengiesser, I'm the CIO of Is Capital. And with me today, I have David Nicholls, who is a portfolio manager for our global emerging market strategy. Typically, we focus on what's happened in the previous quarter, but unfortunately, this time around, I think we need to focus a little bit on what's happening now in the market and what will be the impact on emerging markets and China in particular. But David, why don't you provide us a brief overview how markets have performed year to date?
Sure, yeah. So it's been an absolutely fascinating year in terms of performance. And if you can see here, you can see the broad sort of numbers. And if you look at just Q1 to start with, I mean, it's fascinating in that it was the worst year, the worst quarter for US underperformance relative to the rest of the world since 2002. So emerging markets, China, frontier markets, all significantly outperforming. And that was driven by two narratives. I think the first one is this real question about US supremacy remaining. Of course, you get very expensive valuations, questions about some of these tech companies, and this policy uncertainty created by Trump really caused investors to think, do they really want 70, 80 or 90% of their equities portfolio to be in the US? And then that was really compounded by the second narrative, which was very much the AI story in China, the publication of DeepSeek, which really showed that China can compete at absolutely cutting edge AI, despite some sort of lack of access to the top NVIDIA chips. Of course, however, everything came crashing down at the end of the quarter with these Trump tariff announcements. Clearly, luckily, we have avoided the worst case scenario. But you can see here by the performance, I think it would surprise people. You still have China outperforming US by 11%. Emerging markets outperforming by 5%. So I think despite all the headlines, still been a relatively good start to the year for emerging markets. But yeah, Jacob, you're based in China. You have quite a scary looking Shanghai sunset behind you, I think. Could we just start with where do we stand at the moment? What exactly tariffs have been implemented on China and vice versa, maybe?
Well, it's been a pretty scary week, so I think that's an appropriate background. But I think what we have seen, right, is we have seen an escalation of tariffs from both sides during the week, and we have ended up at a 125% tariffs on Chinese goods being exported to the US and an 84% tariff of US goods being exported to China. These are very high numbers, and I think anything above 50% kills most of the trade in either direction, I probably would say. Having said that, it's a bit asymmetrical. So I think it is hard for the US to live without China because you have $500 billion of exports from China to the US every year. And in the other direction, you have $140 billion. So you have $140 billion of US goods going to China. And China probably could replace at least a very large part of that over time, right? So I think the discussion here in China is basically, how do we continue? How can we live basically without the US? Can we export our EVs to other countries? And by the way, not many EVs are going to the US market, they're going to all other markets, including Europe. And I also think that the Chinese leadership have carefully thought through these tariffs and effectively a trade war with the US, right? I think they feel that they probably can replace, a large part of that going into other markets.
Okay, understood. Yeah, I mean, just talk. What would the economic impact actually be then of these tariffs? I think that's the question everyone's trying to understand.
Yeah, exactly. So first of all, let's just get the numbers straight, right? So it's 14.5% of Chinese exports going to the US. If you include a bit of transshipment, etc., countries like Mexico, Vietnam, maybe you get up to 19-20%. But if you put that number in relationship to GDP, because China is a big economy, right? There's also there's a big domestic market here. US exports to GDP is only 2%. If you look on a country like Vietnam, US exports to GDP is 29%. If you look at a country like Thailand, it's 11%. If you look on Taiwan, it's 13%, right? So it's actually probably a smaller part than you would think. And if you would just take it away, you just remove 2% of GDP, right? It's probably not that simple, but still. If you look on what the brokers have been saying, again, it's been a pretty tough week here, right? So you have seen the escalation of tariffs. But if you look on a 50% tariff or 54% tariff, Goldman Sachs, for example, thinks that there would be zero impact on the economy because the Chinese government will simply stimulate the economy and hence compensate for that lost effect, right? Those lost exports. UBS think it would be 1.5% hit to the economy. Again, incremental from 54 to 125, it's not a major difference. I probably would argue, it probably kills most exports anyway, right, to the US. But I think it's realistic to say that probably you would have a contraction or a lost growth of 50 to 100 basis points, so 0.5 to 1 percentage point of GDP.
Okay, thanks. And how do our portfolios look, particularly in China, with regards to this tariffs? And have we been sort of positioning for it ahead of time? Or?
Yeah, so obviously we put a lot of thought into this, right? And I think that the consensus with Trump stepping into office in January was that he would immediately put high tariffs on China. So our portfolio was positioned for companies not exporting to the US. I mean, we kept it very, very simple. So if you look on our portfolio today, you can see here on, if companies are exporting to the US, and for most of the companies, it's no. But for the ones that are exporting, we are speaking about low single digits of revenue. So it is very, very small. It's not a tangible impact on our portfolio. Again, there are other companies that have a very big part of their exports and overall sales to the US, but for our companies, it's simply not a non-tangible part. I mean, most of the companies we have are pure domestic exposures. So I think that's quite important to point out.
Okay, thank you. And of course, the focus is rightly on tariffs, but as I mentioned at the start, one of the other really key narratives for China this year has been the development of DeepSeek and ability of China to compete on AI. I mean, is that something that's real and has legs, do you think? Yeah,
so I mean, up until this week, we had a very good market in China, right? We had Chinese tech companies for the first time in 5 years really starting to perform. And that was on the back of DeepSeek. We published an article on this in January, but I think that the point really here is that the Chinese companies now have chips that are as good as sort of the mid-end NVIDIA chips, and they have an AI tool or algorithm in the form of DeepSeek that is on par. Maybe it's half a notch worse than the US peers, but I think it's probably good enough for most of the purposes that use AI for. And hence, the Chinese tech companies can compete with the US ones. And living here in China, I see that everyone uses DeepSeek all the time. People speak about it all the time. I don't speak Cantonese or Mandarin, but I hear the word DeepSeek, when you're on the subway or among friends or something like that. So I think it is pretty revolutionary. I think it's probably quite revolutionary for the world, but of course, especially so for China.
Okay, thanks. And maybe we then discuss some of the outside China sort of impact in emerging markets, and one of the countries that we keep on hearing about is, of course, India, right, which is the second or third largest country in the emerging market index. And yeah, I actually met the finance minister of India on Tuesday. She was in London for an investor roundtable and really iterated what this sort of narrative is, that India is relatively untouched by sanctions. Exports to US is a very small portion of Overall GDP, GDP growth is much more driven by sort of domestic consumption and things like that. So I think that's one of the obvious winners. And we see headlines coming up now on a sort of daily basis about how Apple's hurrying to shift its supply chains as much as possible towards India for this iPhone assembly, and ultimately, hopefully, actually, there's sort of more production of some of the more parts. So yeah, I think India definitely stands out. Latin America as well is one of the markets that's held up much better, partly because they just don't really have a very strong manufacturing business and exports business to US for good or for bad. But yeah, I think typically then, Jake, we like to finish with an outlook. What should we be looking for, or what are you looking for going forward over the next few months?
Yeah, well, obviously there's a lot of uncertainty, right? But I think, as you pointed out with India, there probably will be some winners as well. I mean, China might negotiate. I probably think that both sides, both the US and China, they want to negotiate. They'll end up with some sort of tariffs, I'm quite sure, but probably not 125%, right? So we'll see. I think the jury's a bit out on that. But countries like India, might be one of the winners. I think Trump also needs to pick a few winners here, right? So we'll see. I think we'll have a lot of deals being announced in the next 90 days. And the portfolio has been positioned, as I mentioned, especially in China, that we try to avoid basically these tariffs. But in a country like India, we don't have really any exporting companies, right? It's mostly about the domestic economy. So we'll see. There are also some voices saying that it's time to move away from US assets. I don't know. Of course, US assets have been dominating performance and basically what people have in the portfolios. And I think in the first quarter, a lot of people started to ask themselves that maybe it's time to diversify away a little bit from the US and the US dollar, and that clearly would be positive for emerging markets.
Thank you, Jacob, and thank you very much, everyone, for listening. And if you have any questions, please feel free to reach out to us. We're happy to discuss.